Hi everybody, welcome back. This is project number 2 for Finance 695 in fall of 2014. The multi-firm analysis under the guidance of Tricky John Cressel. For this, we pulled 18 different companies between the years of 2010 and 2013. They were all companies that we either worked for or were within our industry if we weren't perfectly traded, with the example of healthcare. These industries range from big oil to large construction, software development, beverages, heavy machinery. So it's pretty diversified sampling. So it made it, sampling apples to apples a little bit difficult at times, but we made it work. Our factors of consideration for this, solvency ratios, specifically on the short term, we use quick, current, and cash ratios. We also use our total debt ratio and equity multiplier, debt to equity ratio, cash coverage ratio, time interest earned. All these, we're intimate with this at this point. Profitability, we looked at ROA, our total asset turnover, profit margin, and ROE. Of course, we did break down the ROE into our DuPont style to give us an idea of what's driving the numbers. Market-based factors, we looked at PE, price to book, earnings per share, or EPS, our average dividend yield across those 4 years, and then for our economic value added measures, our WACC, our weighted average cost of capital, our return on investment capital, and our economic value added. When looking at these 18 firms, I found it useful to go through a series of eliminations. The first was looking at firms who had a negative ROE. Only 2 of them, Amedisys and GTIV, had negatives. They were pretty obvious right from the start. Upon some further analysis, we're able to see that both had negative profit margins, bringing them down. And what further strengthened this elimination for me was the reduction in total equity for both. They were losing equity, selling off assets, and still losing on a profit margin. It's never really a good sign, so that eliminated my vote of confidence from them. Next, we looked at downward trending PE ratios. John Deere was the only one who really had this. From 2010 to 2013, it dropped from just about 16 for a PE ratio down to 8. To me, that tells me that the marketplace is losing confidence in that, usually indicative of a deteriorating growth potential. So for me, if the market doesn't feel real great about it, I'm probably not going to waste my time on it. The 18 quickly moved to 15 as we eliminated John Deere, Amedisys, and Gentiva Health. Next factor that we looked at was if anybody had a price to book -1. Really quickly, the only guy that we showed below that one was URS with 0.83 price to book. That's usually a sign of underlying trouble within the firm. It can be a sign that the firm is undervalued, that the stock is actually undervalued. But with a negative 191.3 million average EVA, that's pretty telling that the firm is going through some issues. So on that accord, URS was dropped. Next, we looked at our economic value added. This is our baseline of 0. Red's, of course, negative, not a very good thing. Jacobs Engineering, MRO, Autodesk, CAT, and CTL all, pretty obviously had some negatives. Autodesk not quite as badly. Jacobs a little bit more so. But Marathon and CenturyLink, both on that average EVA, really, really underperformed. So simply not underperforming wasn't enough either. I looked at CDI and Fluoro. Those guys just barely made it at 41.45 and 97.8 average EVA each. So those are just kind of some broad stroke. What really stood out very quickly, underperformers across the 18. As mentioned earlier, we removed John Deere, Amedisys, and Gentiva. We're also removing URS, Jacobs, Marathon, Autodesk, Caterpillar, John Deere, CenturyLink, and of course Amedisys and Gentiva. The next measure that I looked at was really a question of using debt. Of course, it can magnify gains and or losses. But what I looked at was, in blue, we show how easily the firm is able to earn, to cover their debt, versus the equity multiplier, our kind of hollow red here, is the level of debt. Intuit and Coke both showed much higher levels of their, the ability to cover their interest payments. Valero underperformed just a little bit, but it didn't really cause that much of concern. Their financials were very sound otherwise. Their revenues were high, their liquidity was adequate. So for me that wasn't a huge thing. AT&T was a little bit more concerning, but as we'll see later, they were able to kind of offset my concern with their ability to afford their debt going forward. Tenant health and community health, healthcare not looking so good. As you can see, pretty good amounts of leverage that they're using, and not a whole lot of ease in covering the interest expenses. So with those two, I really didn't feel good about it. On a personal note, though, insider trading. I'm in the healthcare industry, dealing with operations and finance. Two things that are kind of a positive going forward is healthcare has an inelastic demand. So at some point, everyone watching this or in class or related to any of us will need healthcare. And also the maturation of the industry is a good thing. I mean, there's not a ton of new entrants. You're really looking at fairly slim margins as far as new entrants and diversifying what they can do. So with that maturation of the industry, it is a little bit settling. However, there is a very good degree of industry uncertainty right now. For all the fantastic good that the Affordable Care Act does, it does have a pretty high degree of uncertainty as far as compensation and what that entails for healthcare companies in general. As mentioned, decreased compensation. So governmental payers historically pay less. Now they're paying even less than what they did a year before. And those trends look the same going forward. So that really makes our profit margins very, very skinny. So we're having to get creative on ways to figure out how to stay afloat. Finally, governmental regulation. It's a good thing. You don't want some random hacks walking in with a saw doing a surgery. But you also, kind of hate to see the level of intervention and regulation that they have there, where it can be debilitating at times. The final five, we broke it down on a DuPont analysis first. We're left with Valero, Intuit, AT&T, Monster, and Coke. Interesting that the two beverage industry entrants were still there. We had big oil, software development, and telecoms. Things to note on this. Valero had the lowest average ROE between 2010 and 2013 at 10.52 with a 2.48 equity multiplier. So, they had a fair amount of debt, but with that, 1.38 profit margin, it was really kind of, it didn't really inspire a whole lot of confidence. However, on the opposite end of that, Monster had the highest ROE and, of course, ROA in turn with that, which really helped with the lowest equity multiplier that we had there. It looks like they were able to do the most with the least amount of leverage, which was encouraging and a little bit surprising. Coke, unsurprisingly, had the highest average profit margin at 22.29. You'd expect that of a mature company, well seated within that industry. They really kind of represent the stalwart of the final five. Next thing that we looked at for the final five was market-related values. PE ratio, price to book, dividend yield, average EPS. Again, Monster really kind of shined here. An average PE of 28, almost 29. High, I think that might be a little bit overinflated. That does tend to lend itself towards a long-term investment strategy. But Monster is a fairly young company. A lot of growth potential there. Valero at 9.58. Perhaps Valero is kind of on the downturn of its profitability, and existence of a real stalwart within the oil industry. Average price to book. Again, Monster blew everybody out the water. And again, Valero at 1. That really kind of, to me, says that the market doesn't have tremendous confidence in Valero versus Monster. They look at it as a stock that really could be something to look forward to going forward. On the dividend yield, AT&T at 5.47 was encouraging if you're an older investor and you're looking for a dividend sooner rather than later. However, to me, that kind of has a little bit of worry because maybe they don't have as many net present value projects in the works where they don't think, we can make some real changes going forward that are worth an investment. For that industry, though, that may be kind of the case. It is highly competitive. There is a pretty high degree of governmental regulation, and there is a pretty high degree of technological change that affects that. So, perhaps a good dividend yield is something to be concerned, or something that you might want to diversify into. Monster, big fat 0. So they're saying we think that our growth is going to earn more money for you going forward than your money just sitting in the bank. So again, with Monster, you're looking at a firm who really shows growth potential going forward. Coke, again, at 2.72, fairly flat yield. They're a good stock, a good long-term stock. Earnings per share, Monster was low. A lot of that is really because in 2011 they offered their first common equity, or common stock issuing. So, a smaller sample size that really affected that downward movement on that. Valero at 3.26, you would kind of expect that. Huge revenues on that. But of course, their profit margins are a little bit lower, so that may be a false positive on that. The next measure that we looked at for our final 5 was economic value added and return on investment capital. Our ROIC for AT&T, $245 billion. Very, very strong showing by those guys. They're able to do a lot with what they do, what they reinvest into the firm. Monster was on the low end of that spectrum at $768 million. Again, that's a young company. They may be trying to kind of get their feel for how they can grow their infrastructure long term. So that may be something that going forward, if you're checking the stocks or something like that, go, I remember Clint said that. Years down the road, it's interesting to see how that might mature. Their average economic value added was also low. That's probably due to the market, given their old, their past performance, substantial growth. The market has probably gotten a little bit more attuned to that and said, we're gonna expect higher things going forward. So the market was probably closer to what they thought Monster would do. Coke at $2.5 billion economic value added, a little bit surprising. They were able to really kind of outkick their coverage, to a pretty good degree over AT&T. Maybe that's an industry thing, I don't know. Recap of the final 5. Valero had the thinnest profits margins. You would kind of expect that from somebody like, in that oil industry. Your cost of goods sold is always variable, high volatility, so there's going to be risk inherent without the beta. Low price to book and high weighted average cost of capital, as well as a low PE. It didn't really inspire a ton of confidence, but they're still a strong stock. Anybody left in this 5, I would have no qualms in putting some of my money in there. Again, the high degree of industry uncertainty, the fact that oil futures are a traded commodity is pretty telling of that industry in general. Monster, high degree of short-term liquidity. They had, that injection of cash in 2011, and they've held on to that. So a part of me wonders if they couldn't help but, maybe find other places to put that cash to work for their benefit. But being a young company and kind of, probably looking into expanding their infrastructure, they're probably holding on to that cash, for growth potential. Very low total debt ratio, of course, goes with that. A consistent economic value add-up was very promising. They consistently outperformed. So, that upward potential is encouraging. However, underwhelming ROIC did kind of detract from that. I think that's something they'll probably normalize as they grow older again. young, a lot of growth potential, and within that industry, they're kind of niching themselves out a little bit. AT&T unfortunately showed increased short-term liquidity issues. That was, for me, probably the biggest detractor for those guys. However, for a shorter-term investment, that high dividend yield was quite appealing. They're a mature company, a fairly large industry, so you would expect them to be able to kind of absorb any year-to-year misgivings that might happen. However, there is a good degree of governmental regulation involved with that. So, future growth potential and investment opportunities for the firm can be a little bit risky. Intuit was, kind of a quiet giant amongst these five. One thing that really stood out, the increased liquidity while decreasing liabilities without selling common stock. So they were able to decrease their debt levels and increase their liquidity. So, they were able to kind of get that cash injection without selling common stock. So their management is really doing well, especially over the past 3 years. Their EBIT margins were looking good. Very good looking firm from a management standpoint. With all of this, we also saw an increased profit margin. However, their weak ROIC, weighted average cost of capital, and economic value added are a little bit of a concern, but nothing huge. Coke, probably the big boy of the group. Very steady price to book and EPS. The market knows what to expect with these guys. The fact that Coke is synonymous with cola in general is probably pretty telling of that. Very sound profit margins, PE, earnings per share. Dividends has been fairly flat. There's a little bit of a downturn on there, but nothing huge enough that I would really concern myself with the performance of the firm. Economic value added and ROIC were both fantastic. That ROIC, is probably indicative of their diversification within their brand. If you look at their ability to sell Dasani, where they're selling water to us at $1.50 a bottle, so good for them. So ultimately, the big question is, who's the best out of them? Valero, AT&T, Intuit, Monster, or Coca-Cola? If I had to put $10,000, where am I putting it? Well, in traditional Johnny Finance classes, that's a trick question. The correct answer is all of the above. What we want to do is, with each stock, there are pros and cons. We want to try and diversify as much as we can and offset risk by, including all these very strong performers. Well, that's been it. I hope it's been fun for you. Once again, my name is Clint, and this has been the multi-firm analysis for Finance 695. Thank you.